Okay, let's dive right into this high-octane playbook. Today, we're cutting straight through the noise of the Indian financial markets to reveal what actually builds wealth. Welcome to this explainer. We're stripping away all the complex facades of modern investing to look at the unvarnished realities of the India opportunity. If you've been wondering what the smartest capital allocators are doing right now, and more importantly, what they are completely getting wrong, well, you're in exactly the right place. We have a packed agenda for you today. We're going to cover decoding market cycles, the junk warehouse portfolio trap, true asset allocation, the massive shift to manufacturing, tech and finance realities, and finally, the actual timeline for the India opportunity. Let's jump right in.
Section 1. Decoding Indian Market Cycles, Separating Anxiety from History.
First up, we've got to address the elephant in the room. Smart money is selling. But to understand why, you have to look at this sobering reality. India currently represents just 3% of the global profit pool and market cap. That means 97% of the opportunity is still out there. We often get complacent when times are good, assuming India automatically deserves a massive place in global capital markets. But put yourself in the shoes of a foreign investor. The global opportunity is incredibly vast, and capital, well, it always flows to where it's treated best, and where it can compound the most efficiently. So the crucial point here is that while we are definitely seeing a temporary corrective phase with money moving out, the structural foundation of the economy is actually incredibly sound. Yes, foreign institutions, private equity, and venture capitalists are cashing out right now. And yes, the interest rate spread between India and the rest of the world is uniquely compressed. Plus, aggressive retail buying is definitely creating some market froth. But, and this is a big but, here are the core structural realities. First, government finances are in exceptional shape. Second, we didn't see that reckless money-printing frenzy post-COVID like we saw in the West. And third, subsidies are direct with really minimal leakage. So the macro structure is totally intact, even if the short-term cycle is just taking a breather.
Section 2. The Junk Warehouse Portfolio, the Over-Diversification Trap. Okay, this right here exposes the absolute biggest mistake investors are making today. Instead of building a beautifully curated wealth museum, they're building junk warehouses. How does this happen? Well, it happens when capital allocators listen to wealth managers whose primary incentive is just to earn a fat commission by selling you every fashionable, high-fee product under the sun. It's a little bit of angel investing here, some venture debt there, maybe some structured products, offshore funds. The result? You get a disjointed, overly complex mess that completely lacks any unifying strategy.
The truth is, you don't need a slice of every single pie. There's a massive difference between the diversification myth and the mathematical reality. The myth tells you that holding 60 or 70 different positions across every conceivable asset class somehow makes you a sophisticated investor. But the mathematical reality? You are literally just paying exorbitant active fees for what is essentially a passive index-like performance. And worse, it's dragged down by bad apples that just cancel out your good ones. Always remember, complexity is the enemy of returns.
Section 3. Mastering True Asset Allocation, the Blueprint for Capital Deployment.
So, what's the solution? Let's look at how true, simplified asset allocation builds a far more powerful wealth engine than any complex structured product ever could. Here is the ultimate wealth hack. For decades, a simple, low-churn split of 65% in the Indian index and 35% in the Nasdaq would have absolutely beaten almost every active manager out there. It achieves true geographical and currency diversification. Think about how effortless that is. It's highly liquid, it's psychologically easy to manage, and it perfectly captures the local compounding of India alongside those massive global network business models found in the US. No fancy high-fee product required. Asset allocation is literally the single biggest driver of your returns, but it demands discipline, patience, and the willingness to just sit on cash until the valuations actually make sense. Let's break down the optimal playbook point by point. First, define a negative list. Know exactly what you will never, ever touch. Second, start slow. Keep the bulk of your funds in safe, liquid instruments initially. Third, avoid the product pushers and find fiduciaries with true skin in the game. Fourth, use time as your lever, because time is what cooks the business and your conviction. And crucially, point 5, retain liquidity. Having 25% or more in cash isn't a drag on your portfolio. It's pure optionality. It's just waiting for the perfect valuation pitch to swing at. And please, we have to know the difference between an asset that actually compounds cash flow and a commodity like gold. Gold is basically just an inelastic hedge where roughly 800 tons are dug out of the ground globally each year. A true asset generates operating cash flow, it reinvests, it grows. Now, gold and art are fantastic stores of value, for sure. They protect you from terrible government policies and currency devaluation. But they do not yield, they do not compound. Understanding this distinction is absolutely fundamental to structuring a resilient portfolio.
Section 4. The shift to manufacturing. India's geopolitical advantage.
Okay, let's look at specific sectors. The absolute brightest spot on the horizon right now? Physical manufacturing. We are transitioning from exporting code to exporting atoms. This is driven by targeted capex incentives and a desperate global need to diversify supply chains. The China Plus One strategy isn't just some corporate buzzword, it is a vital business continuity mandate for the West. And sure, while India might not have the massive economies of scale that China does, Indian companies possess an incredible frugal capital efficiency. We're seeing real champions emerge with massive order books in sectors like renewable energy, backed by long-term government protection and capital expenditure incentives that are going to pay off for decades. Section 5. Tech and finance realities. Margin compression versus reinvestment. Now, contrasting that excitement in manufacturing, let's look at the sobering realities currently facing the tech and finance sectors. Tech services are facing an existential crisis, with AI completely disrupting their billing models. The IT sector has basically perfected its margins, meaning there's no room left for expansion there, and organic volume growth is totally stalling. Add an AI doing basic coding and customer support, and that old time and materials billing model is deeply threatened. On the other hand, look at finance. Yes, banking is cyclical, but India is vastly underbanked outside the top zip codes. Financial firms here can uniquely deploy large sums of capital at a 16 to 17% return rate. And let me tell you, that is incredibly rare globally. And this brings us to true network businesses, which is exactly why we must look globally for tech. India has great IT-enabled platforms and delivery apps, but it currently lacks true, scalable network businesses. Don't confuse an internet-enabled delivery service with a true network effect. If you order food during a major sports match and the service slows down, that is the exact opposite of a network effect. A true network business, like a global social media platform or a dominant operating system, actually gets more valuable to you the more people use it. Right now, that massive scale of true network economics mostly resides outside of India. Section 6. The India Opportunity Unveiled. The Timeline to True Innovation. Let's map out exactly where the India opportunity actually goes from here. We've got to be realistic. True high-risk R&D and innovation only kicks in when a population's basic needs are fully met. And that will happen as we march toward the $8,000 per capita GDP threshold. Remember, we only really opened our markets in 1992. Today, at around $2,500 per capita, our capital is frugal. It chases execution, it chases services, and traditional business models with proven returns. But give it another few decades. When we cross that $8,000 mark, you are going to see deep risk capital backing massive, world-changing innovation right out of India. But hey, investors absolutely must respect the base rate effect. Do not pay infinite premiums for growth that will inevitably slow down and revert to the mean. It is a statistical impossibility for a company to grow at 30% or 40% forever once it hits a certain size. Eventually, the law of large numbers catches up. That's exactly why buying growth at any price is incredibly dangerous. You have to understand that exceptional margins and growth rates will always attract competition, pulling performance right back down to the industry average. So let's bring it all together. The crucial takeaway from this explainer is to strip the complexity out of your portfolio, focus on high longevity execution, and stay cautiously optimistic about the structural shifts ahead. Point 1. Simplify your asset allocation. Complexity is the enemy of returns. Point 2. Avoid that junk warehouse trap. You do not need to be in every asset class. Point 3. Focus on longevity over breadth. Point 4. Know the difference between compounding businesses and static commodities. And finally, point 5, maintain optimism because creative destruction is going to fuel the next 30 years of the markets. Look at your own portfolio today and ask yourself this genuinely uncomfortable question. Are you building a curated museum of high-conviction wealth, or are you just managing a junk warehouse of expensive fees?